Okay, welcome. We're back. This is the third in a series of TED Talk style classes on private equity as it relates to commercial real estate. My name is Alan Blair, and I am the founder and CEO of the REI Capital Group of companies. And I started in real estate in 1985. And back then, we got into apartment buildings with my family, and there were no computers. There was we did have a text instrument calculator, and everything was by hand. And that's how I learned real estate from the ground up. And I never stopped teaching myself real estate from the ground up, and hands-on all the way, which gives me a certain perspective as we're discussing all of these issues of Tony Robbins' book, The Holy Grail of Investing. I apologize for this, but this is the obligatory disclaimer. I'm not a financial advisor. This presentation is for educational purposes only and not an offer of securities. However, I am a commercial real estate broker licensed in the state of Connecticut, and as such, I am licensed in order to provide investment advice for the acquisition of commercial real estate. So it's a little workaround there. Next. We decided to launch this three-part series based upon Tony Robbins' new book, The Holy Grail of Investing, because he is getting the word out about this Holy Grail of investing everywhere in the world. And quite frankly, I want to ride his coattails a little bit because we are preparing to launch two very special commercial real estate private equity designer funds. And I wanted to know what he was saying. And I wanted to know who he was saying it to, who was his audience. And I wanted to know how he said it, because communicating complex ideas to people is really, really hard in order for them to receive it in a simple way. And Tony Robbins is the master. And I wanted to see how he did it because I'm still learning from Tony Robbins after all these years. Next. So we're going to go through some of the basics, the four principles of investing that he, talks about in the book. We talked about, the first principle, Warren Buffett's don't lose money. And the second principle is look at the first principle. And we talked about if you lose 50 and you need 100%, we don't have to repeat that. So the second principle is asset allocation. Basic stuff, but let's play the video.
They all agreed on something that sounds complex. The most important part of your investment future, you don't have to be a genius, is what's called asset allocation. Big words. All it means is you have a certain amount of money to invest, $1,000, $1 million, doesn't matter. You have to have a pre-designed way you're going to do that says, I'm going to take some of this, some percentage, 10, 20, 30, 40, 50, and put it in something that's secure, meaning low risk, probably low return, but over time it'll compound. Like it looks like grass growing until it's the tortoise and the hare. Another percentage of my money I want to put in areas that are more high risk, potentially higher return. But if I lose it all, I need to make sure my security bucket kind of takes care of me. And so they laid this thing out. Each one of them laid it out for me. And they never bet the whole farm on one thing. That's why they succeed. Pretty simple.
Okay, next slide. Notice he mentioned compounding returns again. It's a theme that goes throughout the entire book and his video series. The next one is asymmetric risk. So now it's starting to get a little interesting. Play it.
Third principle was you got to look for what they call asymmetrical risk reward. These words are so big. All it means is where can I invest with the least amount of risk with the most amount of upside? So if you look at really wealthy people, you think they take giant risks. It may look like it. Like, I don't know if you've met Richard Branson, but he's a friend of mine. And Richard, he's risked his life in so many ways, going into space, going across the ocean, going in balloons. But if you look about how he invests, his whole thing is, what's the downside? How do we protect the downside? How do we make this asymmetrical?
So here he gives us an idea of what he's talking about with asymmetrical risk, but he doesn't really say anything. But he's leading up to the next video, which we'll go in a second, which is where Paul Tudor Jones, his friend, gives him investment advice. And we'll get to that in a second. But before we do that, I want to just review verbally, make sure everybody understands what they're talking about in the book and in the larger videos when you talk about private credit. So private credit is, for those of you who are old enough to remember loan sharks? Everybody remember loan sharks? That used to be illegal, right? It used to be run by organized crime, and they'd charge you outrageous percentages, and if you didn't pay up, you'd break your legs and all that good stuff. Well, somewhere along the line, I don't know when, they made it legal. So now a lot of people with money will make loans to individuals that need it. I mean, on the level that Tony's talking about, it's all very business-like, it's very corporate, it's very, very clean, very wonderful. But there are a lot of layers between them and everybody else who needs to borrow money. And it is very, the term they use when they're raising money for these funds is opportunistic. And what that means is they're basically looking to scrape equity off of the backs of people who own things and are desperate because the government has done what they've done and now they need to borrow money. And they charge the highest rates that they could charge to get all the cash out of whatever business or real estate that they're doing. And because the banks won't lend anymore. The banks won't lend anymore, again, because of government rules and regulations that have the boot of the government on the banks next, a la the recent bank failures. That does all happen because of regulations. So, a lot of people with money have put it into these credit funds because everybody's desperate to borrow, and they charge outrageous interest rates. And I know one organization that charges it. They mask the rate in a way that it seems easy because they take it off of credit card charges and they adjust it on a daily basis. But ultimately, they're getting over 30% return on their money that they put out. So it is, on certain levels, a little bit of a opportunistic. Next slide. So here's where Paul Tudor Jones tells Tony Robbins where he invests all of his money. You're not going to see this on a video, but just before this, Paul tells Tony, he said, "Tony, can I tell you where I invest almost all my money?" And Tony says, "So I'm leaning in, I'm listening, I'm waiting for him to tell me." And then we'll pick it up. Go ahead.
There's a way for you where you don't have to try to get in, where you can buy a tiny sliver of the ownership of the companies that own all those funds. And then you get the 2 and 20. You get cash flow and the growth like you're an owner right side by side with them. I said, what? And he started explaining to me how that happens. And so now I own a piece of 65 different private equity firms, like Vista, $100 billion firm, written by one of the smartest people I know, Robert Smith. He built things in the SaaS industry. I have them across different industries. They're all multi-billion dollar, 10, 20, 30, 40, 50, $100 billion firms, and I have a sliver of each of them as an owner. And then I don't just get one fund, I get all the funds, the ones they did in the past, the ones they're doing now, the ones they do in the future.
Pause it. So I forgot to mention, before I play the video, I wanted to explain what the 2 and 20 is, because that's kind of important for this one and the next one. The 2 and 20 is when a sponsor or a general partner who's raising a fund will raise the capital, invest it, and as a fund manager will collect on average, those are typical fees, about 2% of the assets under management annually as a fund management fee or as an asset management fee or a combination of the above. So that money comes in as the investor money is put to work doing whatever they're doing. So he raises 2%. Now, fund sponsor isn't doing all of this work and operating these businesses and doing everything for 2% of the assets under management. So the business proposition is that they're going to make a lot of money, and what they will do is they'll offer their investors a minimum rate of return of some percentage, call it 8% for now. And then when they make a lot of money above the 8% average annual 8% to the investors, they will split the profits above that, and the sponsor is going to get, on typical, 20% of the profits above that. The investors get 80%. In other cases, in the small private equity deals that I've done, it was 2 and 30, for example. There's other big development deals where they call it a waterfall, where it changes the more profit they make. So with that, continue. So right there, Tony was actually disclosing the little-known secret of the elite 1%. Next slide. And what he was talking about is general partner stakes. It's a relatively new concept. And he's going to repeat the 2 and 20 piece here again. So I'm not going to repeat it for you. So play the tape.
Nice to have the smartest people in the world on your side and be their partner, making 2% right beside them as an owner in the business and making 20% of the upside. Think about it. These are very few of them this small, $1 billion in funds. They're going to be guaranteed 20%, right? That's what their 2% is going to give them $20 million a year for 5 years. They're going to make $100 million whether they make money or not. And most of them are good at making money. So in 5 years, they take the $1 billion to $2 billion. Didn't have to hire a ton more people, and they're going to make 20% of the upside. They make $300 million on $1 billion. That's why there's more of those in the Fortune 400 than any other industry. So I said, there's a good pathway. Perhaps that's a pathway you and I should take advantage of.
So Tony's co-author of the book is a man by the name of Christopher Zuk. And Christopher's company, CAS in Houston, is the company that Paul Tudor Jones advised Tony is where he invests all his money. So if you go to CAS company, you find that he's got 26 or 36 different funds, all with different themes of investing in different general partner stakes. All general partner stakes. Now, general partner stakes is asymmetrical investments, small risk, big return, because of what he just said. You accumulate the money, you invest it. The general partner is getting 2% every year, whether the fund makes money or not, but generally they will because they're good at it. And the returns are phenomenal. So that's what general partner stakes are. However, when you dig a little deeper at CAS, you have to be a qualified investor to participate in this thing. So once again, we're back into the same issue that it's not available, not even available to unaccredited, it's not even available to accredited investors. You have to be $5 million or above level. So it doesn't exist for you. And even if you had the money, because you have to be good looking, you have to be famous, you have to write big checks and all that. It's an in crowd, it's an in club. You have to be part of it. So general partner stakes. One of the things I hope to get out of this is, if there was a general partner stakes opportunity available to either accredited or unaccredited, could you now recognize it as such? Next slide. my final thoughts. So, a couple things. My opinion of what the true Holy Grail is, and definition of luck. And there's a reason why I pointed that out. Granted, the wisest man that I ever knew told me something that I think was brilliant. And it's a bit of a brain teaser, so follow along, please. And the message was, it's very, very, very easy to make millions of dollars. Silence. Okay. How? He said, well, you get millions of dollars, you invested wisely, and you make millions and millions of dollars. Piece of cake. He said, well, how do you get the millions of dollars? That's the trick. How do you do it? So the lesson is 2 lessons. One is money makes money. All right? And the second lesson is access to that capital, other people's money. In my opinion, that is the Holy Grail. Because with that, you don't have to be brilliant to make lots of money. Because when you can write a big fat check, the deals come to you. You can pick and choose. Just like he's talking about throughout this book, that, a lot of these deals, the money rushes in and they close the doors. They're all full, sorry, come back next time. That's because people are impressed with a lot of zeros and they think they're brilliant. They just have access to capital. That's the Holy Grail. And they very rarely ever tell you how they originally got access to capital. So that's the secret. That's the Holy Grail that nobody's found. Or everybody finds their own Holy Grail. One of the little phrases that Christopher Zook coined in the book, which I liked, it has to do with the principle underneath what he built in his funds. And that is, he's built a network of high net worth people investing as one. So they all put into a fund, they all invest as one. And they invest as one institutional investor because the numbers are so large. And he coined a term called instividual. And institutional, and anyway, I thought it was cool. So a lot of people think that successful people are lucky. They're just lucky. They're all born, to be honest, if they're born into it, that's a bit of luck. And if they don't piss it away, that's not luck. That's where they make their own luck. And the reason why I brought that up is because in the interviews at the end of the book, he interviews Barry Sternlicht, CEO of what's the name? Starwood Hotels and Starwood Funds. And Barry Sternlicht used the phrase about how what his definition of luck was, and that definition is when preparedness meets opportunity, and opportunities cross your path every day. That's luck. So you make your own luck by being prepared. And the reason why that caught my attention is because I learned that definition of luck 40 years ago from Earl Nightingale in his audiobook series, Lead the Field. It was a brilliant self-help audiobook series that has guided me my whole life. And so wealthy people that are the audience for Tony Robbins' book, they're no smarter, they're no luckier than any one of us. The wealthy worry more about losing what they've accomplished than they do about making more. Preservation of wealth. And one of the reasons why they have good reason to worry about that is because as they get older and it passes down to their children, they worry about, schools do not teach money anymore. And that's true for the wealthy and the not so wealthy. So people learn about money from their parents, their mentors, their friends, self-study, their employers, and very often they don't learn, in which case there's reason to be worried. Next slide. So the objectives of this three-part series of the masterclass: to understand risk and your ability to manage it. Is risk something you do or you don't understand? Is it risky because you do or you do not understand something? Is it risky, whatever it is you're looking at, is it risky because it's too good to be true, or because of who is offering it to you? You trust, you don't trust. Or is it risky because it's on the public markets and there's no control and you don't know what's coming around the corner? So, second point is learn about the different perspectives of people within the industry and how that affects you. Know what licensed financial professionals can do. Know what they're allowed to say, what they're not allowed to say, how they can help you and how they can't. And remember what uncorrelated really looks like if it's uncorrelated. And it could be direct or indirect, as I mentioned before. Commercial real estate is the only asset class, in my opinion, that can be structured to provide real compounding return that is truly uncorrelated to the volatility of the public markets. And this is how more wealth has been created in the United States of America than all the other asset classes combined historically. So, general partner stakes, asymmetrical risk. Remember that. Next slide. So, the holy grail of investing. The largest investor community in the world. Hardworking, middle-class people are completely ignored in this universe of high net worth investing. The giant middle class. So, you tell me, how successful do you think a commercial real estate private equity designed fund, designed to two funds designed symbiotically, one to provide compounding annual growth uncorrelated to the markets, designed specifically for non-accredited investors so they can get in easily and have liquidity, and the other fund being a debt fund, a private equity credit fund, but that is not so much opportunistic as it is symbiotic with the equity fund to provide secure debt for the acquisition of the equity products, working together to provide investors, average, everyday working, hardworking citizens, a really good interest rate return for people who need income, and a really great compounding growth uncorrelated to the markets that need growth for the long term, like that 19-year-old that Tony was talking about earlier. These two products can do that. So, you tell me how successful you think they will be, and they would be investing as a community together, just like Christopher Zook mentioned, and they would be able to invest with a sponsor or a general partner whose mission it is to provide them the opportunity to invest like the top 1% of this country without getting slaughtered at the next crash. So took 7 years to figure it out. And with direct access to capital, anybody can have the same type of investments as Tony's billionaire friends. So these are the risks as it can get. And these are the lowest risk funds that I can think of. And there, I said it. I'm a commercial real estate broker. Next slide. So, okay. So, that ends the third masterclass on Tony Robbins' Holy Grail of investing. And we'll keep the video running for a second because I want to ask, in a discussion manner, did anybody recognize the fact that general partner stakes looks like something that you may have heard me talk about before, called an anchor? And with Tony's brilliant explanation, how it's asymmetrical risk. And, because I've gotten a lot of objections from people that felt that it was too risky. I'm very risk averse. I got all my money in the stock market. Okay. So I would urge everybody here and everybody who's watching my video, because this part will only be shown to my network of friends and family, and to reconsider, reach out to me based upon what you've learned from Tony Robbins' book. Ask me the questions that you've learned. Ask me about the language. Ask me what the words mean. Ask me about the regulations. And I'd be happy to answer you. And I urge you to reconsider the gift, the opportunity that I'm offering only to my friends and family. Thanks. That ends. Done.